This is Fintech Insider News, and this week, Apple is reportedly in talks with JPMorgan to take over its card business. 2 US senators are pushing for regulatory crackdown on banking-as-a-service providers, and it's a slow rebound for fintech funding, with H1 2024 deals down almost 50% year-on-year. We will be discussing all of this and more on today's show.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Hello and welcome to episode 899 of Fintech Insider. Gosh, it's almost 900, so close. I'm David Barton-Grimley, Fintech Strategy Director at 11FS, and I'm joined this week on Fintech Insider News by 2 guests who are here to break down the biggest stories from the past week in fintech and financial services. So first up, we have a return to Fintech Insider for Sophie Winwood, operating partner at Foxe Capital. Sophie, it's always great to have you on the podcast. Can you tell us a little bit about what you've been up to since we last spoke to you?
Yeah, absolutely. I think we're back kind of full conference mode. So TechBug last week, going to be in Copenhagen for Nordic FinTech Week next week. So really excited. There's a lot of energy in the space, which I'm sure we'll come on to talk to around the investment, but very excited for what's going to come over the next couple of months.
Great to hear. And up next, a Fintech Insider debut for Kevin Foxe, Chief Revenue Officer at Thredd. Kevin, welcome to the podcast. Tell us a little bit about the work you do at Thredd.
Yeah, it's a pleasure to be here. Many of my colleagues have participated in the podcast, so it's great to join and participate today. For those of you who may not be familiar with Thredd, we're a leading financial technology enabler with headquarters in London, but presence across the globe. And we support hundreds of organizations looking to deliver innovative financial services and disrupt the payments ecosystem in general. We rebranded from GPS last year, Global Processing Services, who many may be more familiar with, as the platform that launched and scaled many of the most renowned neobanks of our time, including Revolut, Monzo, Starling, and others. We continue to innovate our next-gen stack and have aggressively expanded our footprint across the globe to support our clients, including the US, which I understand is going to be a topic of discussion today. So again, happy to be here.
Awesome. It's good to have you. Yes, it's a very, very interesting news week today. So, right, let's get on to it and on to our top story this week. And this was first reported in the Wall Street Journal. Apple reportedly in talks with JPMorgan to take over its card business. The tech giant is in conversations that could see JPMorgan Chase replace Goldman Sachs as the bank for its Apple Card program. Apple's deal with Goldman Sachs unraveled this year following reports that the investment bank had lost $1 billion from the partnership. The Wall Street Journal has reported that JPMorgan is looking to pay less than the $17 billion face value of the existing Apple Card loans due to elevated losses from the product so far. Neither company has commented on the reports as of the time of recording. So, Sophia, I'd like to come to you first. I mean, if these reports are true, is this a canny move? Why should JPMorgan be so optimistic about this?
Yeah, I think if you look at Goldman Sachs, and they've traditionally been more focused on the investment banking and more of the B2B, and they had this foray into retail, and they thought that was going to be a driving sort of growth angle. And then very quickly realized they didn't have the key competencies and have kind of backed out from a lot of those things that they have tried. Whereas JP Morgan, of course, largest credit card issuer in the US, and has a lot of experience managing consumer credit. And so, hopefully with that experience and also hopefully kind of getting as they might get a good deal in this transaction, they might have a better chance. But I think, there are still a couple of pitfalls that they'll be seeing ahead.
Right. It's definitely more in their wheelhouse, right? As you say. I mean, what do you think, Kevin? Is it a better fit?
I would agree with Sophie. Goldman Sachs is traditionally more focused on the affluent sector. They're attempting to go down market here. They also had some challenges with Marcus, as you may be familiar with. And JPMorgan really, I think, is better served to manage this program. They're really positioned. They're in a position of leverage, if you will, because they can just come in and swoop and acquire a distressed asset at a discount, frankly, which could demonstrate some opportunities for a return. But ultimately, I think what's interesting here is that there's a fundamental disconnect between Apple and the banks with regards to their vision.
Yes.
Apple wants to maximize their user experience and increase their hardware sales, in essence, right? That's their core objective, and the banks are more concerned with compliance and risk management. So, no pun intended, but it's almost like apples and oranges here, with regards to what they're attempting to solve for. But I do think that there's some potential yet for the Apple Card, and ultimately the Apple Wallet in general is going to evolve as a value proposition, and we'll see how that evolves.
You're right. And actually, there's a news item a little bit later about Apple as well. It seems in some ways like a bit of a baptism of fire. Like the thesis works. So you've got more than 1 billion Apple iPhone users. You've got something like 507 million Apple Pay users. But there are definitely some difficulties. I mean, Sophie, back to you. Like, what would you say are some of the pitfalls that JPM might face? I mean, like regulatory scrutiny, for example.
Regulatory scrutiny is, the big thing for these big banks, as they're getting it left, right, and center from everywhere at the moment. And I think, given kind of Goldman Sachs's experience, I imagine there will be a lot of scrutiny around the policies that they have in place. I think fintech as an industry as a whole is getting very scrutinized. We'll go on to talk about that later. But that's the big one. I think the other two are around what Kevin mentioned in Apple's kind of putting the user first, and some of the unique things. An example is the billing system, where Apple uses a calendar-based billing system, which is just not aligned with traditional banks and has caused a lot of operational complexity for Goldman Sachs. And I think JPMorgan are looking to renegotiate that. And the third one really is given the target audience of this is kind of the risk of the defaults or any sort of risk with their consumer segment. So yeah, I think JPMorgan will be all over those, and I'm sure many more risks underneath.
Maybe they can think of a different proposition. I mean, Kevin, looking into the future of Apple Card, what do you see as being their future? And I think specifically in reference to the EU sort of forcing them to open it up, right? Could that like barrel roll into other markets around the world?
I believe it can. I mean, as you're familiar internationally, the attitudes toward credit are fundamentally different than they are in the US. So the TAM may be a challenge, and they'll have to determine which markets are going to be best served to bring these solutions to bear. I think, to Sophie's point again, if you think about Apple and how maniacal they are about their brand and their image, you can just imagine how concerned they might be having a consumer who's an Apple enthusiast, who is denied credit for the Apple Card. So there's this disconnect here where I think Apple's intention is to get it into the financial services business, but the means to an end is to really drive more hardware and software sales. Ultimately, I think that where this is going, the Apple Card is just a means to an end, and it's a component of the Apple Wallet strategy in general, which is going to be. It's going to include more reward-centric kind of value propositions, loyalty, even identification. Your identification can be included in your wallet. So whatever your physical wallet, may entail, your digital wallet will ultimately will have inside, and you'll be able to utilize it in that fashion. So I think that's really where they're headed. And these financial instruments are just a piece of a bigger, more comprehensive strategy.
Like a means to an end. Sophie, what's your view on the future of Apple Card?
Yeah, I think the thing that I found interesting when I was looking at this article is that the show is called Fintech Insider. I look at a lot of early stage fintech companies and kind of the promise of fintech is these disruptors. And here you have big tech working with big bank. And we're calling it fintech because it essentially is fintech, but it's kind of a little bit sad that we have these two behemoths kind of innovating when, hopefully there will be some other kind of, disruptors coming on. But yeah, look, I every single item that I own technology-wise is an Apple product. Unfortunately, I am in their ecosystem, and so hoping that the credit card comes to the UK next. But I think there needs to be this continuing evolution between big tech and big bank, and hopefully some of the kind of younger, earlier fintechs might see an opportunity here that they could be a little bit more flexible, but obviously build with regulation and compliance forward as well.
Yeah, I agree. It'll be so interesting to see what happens now that the digital wallet has been partially forced open, and how some of the PSPs really sort of jump into that and take advantage of it. It's all to be seen. And as we were talking about, there is another very interesting Apple article coming up later in the pod. So right, let's go on to our next story. And this one is something that's been coming up quite a lot. It's from Banking Dive. US senators push for crackdown on banking-as-a-service providers. Senate Democrats Elizabeth Warren and Chris Van Hollen have written an open letter urging regulators to ban BaaS firms from claiming Federal Deposit Insurance Corp protections. In effect, this would mean that consumers would not be presented with the same assurances about fintech bank partnerships as they would with traditional banking products. I mean, you could argue that this is an existential threat to the BaaS industry in the US in total. It's part of a broader effort in Congress to bring attention to these partnerships, particularly in light of Synapse's collapse back in May, which left more than 100,000 customers unable to access their funds. The FDIC itself has since responded, outlining plans to strengthen custodial deposit rules to shield consumers against Synapse-style collapses. Now, our Insights show this week is absolutely all about this topic, but for those who might not be across this, Kevin, what's the crisis that this is in response to? What's the problem that needs to be solved here?
Well, if you kind of take a step back, I see this as almost wave 2.0. So wave 1.0 was back in 2010. I may be dating myself here in the industry, but this is when we started seeing the iteration of banking alternatives to traditional checking accounts from the Wells Fargos and the JPMorgan and the like. So Bancorp was really the pioneer here. And they kind of got into this business, but they quickly got a cease and desist order from the FDIC and the OCC, and they were basically asked to demonstrate, their procedures, their policies, that they have the resources necessary to support this value proposition. It took them like 6 to 7 years. I believe they invested $50 to $100 million to build out their compliance business as a consequence. And the big banks at the time were in the sponsor business, but specifically for government disbursement programs, so the mass disbursements for government subsidies. So kind of fast forward to 2016, it's been kind of a perfect storm from my perspective. You had this proliferation of fintechs after the financial crisis, right? Which were disintermediating the financial institutions. Lots of funding was available. It almost seemed unlimited. It was almost free money, if you will. And then neobanks started sprouting up. Money's flowing in. They're looking to create card accounts. Most of the value propositions were prepaid in nature, stored value propositions. Where the regs came in and the CFPB included it in Reg E, prepaid within the Reg E structure. So there was this gold rush to get products into the market quickly, all kinds of niche offerings like parent-child propositions and expense management and urged wage access. All this really started flowing in. And obviously the ubiquity of mobile devices just gave consumers access to banking services in the palm of their hand. So, all of this, again, was accelerated by the pandemic, all right? So the need to have, financial services without any physical interaction. So the Uber Eats and the DoorDash, Instacart, curbside ordering, Amazon delivery, e-commerce in general, that just really helped proliferate the opportunity. But all of these organizations needed to find regulated financial institutions to sponsor their programs, right? So the ones that really kind of bubbled up were those that kind of came in below the Durbin line, which is less than 10 billion in assets, where they had an advantage from an interchange perspective. It was an opportunity for these smaller banks that were traditionally focused on, consumer or commercial type value propositions in rural areas to kind of increase deposits very quickly. And it demonstrated some accelerated growth opportunities. And the real challenge here was that the requirements from the regulators were, I would say, either unclear or not well understood or simply not well monitored, right? So the result was that these banks that participated in this ecosystem were, in essence, relying on third parties for compliance and transaction monitoring. So they were, they're the ones on the hook. They're accountable by the feds, but they're essentially outsourcing this discipline. So it's almost like the wild, wild west, right? And, additional factors that kind of were a multiplier effect post-COVID, I'd say, the higher interest rates kind of, the money dried up. So a lot of these fintechs, were challenged to try to get investment. The investment appetite was reduced. Money was more expensive. The crypto winter didn't help with FTX and Binance and others. And then there's a lot of defaults on loans, right? So, when you look at the whole FDIC insurance component of the letter from Senators, Warren and the other senators, basically, the FDIC has always had strong controls, and they pay very close attention to the use of their logo. So there's strict rules and guidelines. So only regulated banks can use the FDIC logo. If not, you get a cease and desist letter. But what's happened is a lot of the banking as a service providers and the participants in that ecosystem they utilized the FDIC insured tagline, not necessarily the logo, but they incorporated it into their marketing messaging, which gave this false impression to consumers that things were protected. Now, FDIC insurance, it's important to note that it only covers, it only protects for losses in the event of a bank failure. So if you think the case in point with regards to Evolve and Synapse, Evolve Bank did not fail. Synapse failed. Right? So the reason why we're seeing a lot of flexing from the feds is that the FDIC insurance does not cover any circumstances where, let's say, a bank basically is loses track of the money, or there's poor record keeping in processes, or if they have a sponsor, a fintech that they're sponsoring that happens to be a fraudster or a Ponzi scheme, which has happened, right? The challenge you have is that it's really hard to market this FDIC message to consumers. How do you clearly communicate that FDIC, only covers in the event that a bank fails, but this entity that you're engaged with, it's almost like having a warranty on a vehicle, but it only applies to the engine fails. Yeah. The rest doesn't, right? So again, kind of what's next? I think there's definitely going to be tighter rules on processes. Just yesterday or day before yesterday, there was another ruling that was published with regards to the reconciliation of custodial accounts. What ultimately this is a consequence of the Synapse debacle. And what the feds realized is that they're trying to go in and get access to data and information and files that they weren't able to access from the bank because they resided with Synapse, who's no longer a viable entity. So what they're doing is they're trying to find ways to make sure that all these records are available at the bank, that they have this golden source of truth. However, I don't expect any really detailed legislation to be approved as to what a bank can or can't do. It's going to be more rule-based, mm-hmm. right? I have a feeling that the rule-making changes are going to, maybe this rule that came out a couple of days ago is going to change a bit when they get, feedback from the comment period, which I think is like 60 days. And you got to remember that there's some big players in this space now too. JPMorgan, Fifth Third, HSBC, Wells Fargo, they've all jumped into to the game. So it's going to require a congressional action to really make some significant changes. I think that's unlikely. So I don't think this is a catastrophe. It's a reset, not a catastrophe, right? And kind of just some final thoughts is, the U.S. is actually behind here, and I think tightened regulation is healthy and it's needed, right? Europe, can serve as a precedent. I know it's a different market, different landscape, but kind of gone through and weathered the storm with the likes of Wirecard and Railsr and the Bank of Lithuania and all these things that happened in the recent past. So banks in the U.S. are going to be forced to be more engaged and own the compliance discipline. So I think we're going to see an increased demand for compliance as a service and risk management as a core competency. Strong KYC, KYB policies, real-time AML tooling, robust SARS reporting, and just real-time transaction monitoring and fraud. This is where the battle is going to be fought. It's going to move from a more customer centricity type focused proposition, which is more UX, UI, feature functionality, to a more compliance centric proposition. So I would predict that, ultimately what the feds are looking to do is kind of filter out the smaller players here. They're gonna elevate the bar with regards to what's required from a back office regulatory and compliance perspective. Many of the smaller players are going to realize they just don't have the wherewithal, the resources, or the ability to invest. So they're going to kind of fall out, and you're going to see, some players bubble to the top, and ultimately, I think this is what the feds are looking for, is to reduce the overall ecosystem associated with these types of offerings.
It's so fascinating listening to you talk, and thanks for that, actually, because that was actually a wonderful view all the way from the start of where we are today. That it is both needed and it can spur innovation, because if embedded finance is going to become as ubiquitous and as everyone says it is, and if it's going to hit the $1 trillion valuations that we keep seeing sort of flying around, then it needs these kind of controls. Yet at the same time, bringing this in can in some sense stifle some of the smaller businesses trying to get into the space. And Sophie, I'd love to come to you on this. I mean, as Kevin was saying, in Europe and the UK, it is a very different organizing picture, the way that this industry comes together. How do you think this impacts the investment side of things overall?
Yeah, I think it was even quoted in the article that banking as service revenue is expected to rise tenfold to 17.3 billion in 2026. That feels almost slightly outdated, that number. I feel like it's probably going to be more than that. And I think with this, you kind of need to differentiate between a bad actor and a bad investment opportunity. And I think the same happened with FTX, is that a lot of people equate the two to be the same, when that is not true. There's a huge amount of opportunity within this space, but we will definitely see, and we have seen, increased investor caution and scrutiny, rightly so. And I think with all of these things, I don't think that's a bad thing. I think what happened in the sort of highs of 2021, 2022 is that a lot of these, the diligence processes, a lot of these companies was short. It was very competitive to get into these deals. And so some of the diligence around kind of the regulation and some of the more difficult aspects of compliance sort of went out the window. Mm-hmm. And hopefully now what we'll see is just really quality businesses and business models being built and funded, and kind of the opportunity is still big. It just might be that it takes a bit longer to get there, and that you have less companies but higher quality sort of attacking it.
So it's so fascinating. And also, like, what is your view, I guess, both of you, for the market for BaaS providers in general? I mean, I suppose my take on it is, yes, you can have a proliferation of platforms and embedded finance providers, but just how big is the market for actual, license holding BaaS companies? If you look in a market like the UK, for example, is it a question of saying this market is just so big that, every high street bank that you see can all of a sudden become a BaaS provider? I mean, I know lots are thinking about it. But just how big is the market for that sort of license holder side, or is it more at the top end of the market where people are building services on top of these fundamental capabilities? Because it's interesting. There's almost like a consolidation story at that bottom level of the stack, right? Where only a few really good, big international players can survive. They have the kind of the tech stack and the money to put into that stack and that compliance to make it work. If anyone has any views.
Yeah, I mean, I can address that. So if you take a look, I think it's important to define what BaaS is, right? Because it's a loosely used term. And if you look at the names that were specifically identified in the letter from Senators Warren and Van Hollen, they mention companies like Stripe. They mention companies like Synapse, obviously. They throw Marqeta in the mix too. I mean, these are very, very fundamentally different business models, right? They're all part of the banking as a service ecosystem, but it's important to understand the various disciplines in the value chain that really make up the delivery of these financial services. So you obviously have the regulated component. You have to have a regulated entity that serves to to take deposits and meet the compliance standard. They're ultimately on the hook. But then you got the tech piece where you need to have the delivery of the money movement, the issuing of the account and the cards, the transaction processing and the switching and the connectivity to the card schemes or the payment networks like Visa, MasterCard, et cetera. And they have mandates and standards that you have to meet as well. Then the next piece is the real area where the consent orders are focused on, and what I think is the crux of the issue here is the compliance bit, right? So the fact that it's in essence been outsourced, and a lot of these smaller banks kind of look the other way. But there's another component here, which is identified as program management, and program management really is all the commercial, operational, financial, legal support requirements needed to be able to satisfy programs of this nature. And this goes from customer service, whether it be contact center IVR to back office reconciliation of files to disputes and chargebacks. There's many other elements here. So the combination of all these things is really what banking as a service is offering, and there's no one player that does everything. Right. So trying to impose regulation across this value chain is going to be a real challenge for the regs.
Just so interesting to see what happens. And on that note, we're just going to take a quick pause here. Back shortly.
This episode is brought to you by Coffee Mate. Coffee Mate is the world's biggest coffee lover because we love all the ways you enjoy. Wait. Coffee Mate can't love coffee more than me. I'm a foodie. I went to Kyoto just for a nitro matcha latte. What? Oh, I have to finish the ad. Coffee Mate, for the love of coffee.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See detail.
All right, welcome back. Before we dive back into the rest of the show, we want to tell you about our latest Insights episode. So if you liked our previous segment on the banking as a service crisis before the break, you'll love this. I'm joined by a panel of BaaS experts as we discuss how the collapse of Synapse caused a disastrous ripple effect that has hurt consumers as well as the sector as a whole. We'll be asking, how did the industry not see this coming at all? All right, now back to the news. And this one comes from Fintech Global. H1 fintech funding is down by nearly 50% year on year. It's a huge figure. So new stats from Fintech Global Research show a steep drop-off in global fintech funding in H1 2024. The number of deals done has been slashed by nearly 50% to 2,754, down from 5,449 this time last year. US fintechs are still dominant, taking 5 out of the top 10 spaces, but it's the UK lending fintech Abound that takes the top spot with a massive $1 billion funding round earlier in this year. So, Sophie, I have to come to you first. I mean, why are we not seeing the bounce back yet? There seems to be so many mixed messages out there about what's happening with the market.
Yeah, I think as usual, has been the sort of venture capital market around fintech is somewhat contradictory. So you do have some kind of companies raising mega rounds, and you're also seeing a lot of seed activity. But kind of post seed and within that growth, you're seeing not many deals being done. You're seeing a lot of flat and down rounds, and also a lot of companies running out of money. And I think that is, fintech and financial technology is more impacted by the macroeconomic climate than a lot of other kind of sub industries within venture. So kind of persistent high interest rates are going to be affecting certain business models. The geopolitical volatility is also going to make people fairly risk adverse in terms of this. And then you also have a lot of the things that we were talking about in terms of fintech is not only are you building in an environment where you have to build defensible technology, you also have to be on top of the regulatory landscape. You also have to be on top of your compliance, and you also have to work with multiple different third parties and stakeholders within the industry to be able to scale and progress. And all of those things make it a very difficult kind of proposition at the moment. Now, again, when we talk about the opportunity, I think we're all aware on this podcast and beyond that it's still absolutely huge. However, just given where we are in the terms of the cycle, we're not that far off, unfortunately. Every year I'm like, or every month I'm like, now is the end, now is the bottom, can we go up now? But we're not that far off when it crashed like 2 years ago. So I think, we're not. Maybe we're at the bottom, maybe we're not, but I think it's not going to be like a sharp bounce back anytime soon.
Yeah, and those economic headwinds haven't really gone away, as you say, across pretty much everything. And and from the last segment, we were just talking about regulatory scrutiny and uncertainty in the BaaS market, which is kind of an organizing industry subsector for so much of what is fintech. I mean, is maybe sort of a two-parter question for you. Is there a part of fintech or a subsector within fintech which perhaps you're most excited about that is attracting the money? Yeah, and when do you think a lift could come?
Yeah, I think clang buzzword, AI and fintech, I think is very interesting. And I think given sort of the data that a lot of these financial services and fintech companies sits on, and also the ability to sort of augment a lot of the customer services part of it is really interesting. We're seeing a lot of investment in that space. The other thing that I personally get really excited about, it was super nerdy until recently, is innovation in accounting and tax, and being able to automatically categorize transactions, which allows you to do things a lot more easily. Everyone hates tax. Everyone wants it to be solved. And we're definitely seeing a lot of investment pour into that space. And then the other one that sort of, I think, people are a bit wary of, but still see the opportunities in insurance and insurtech. It's a relatively capital intensive business. It's quite complicated, but it's absolutely ripe for disruption. And while I think a lot of investors have taken a bit of time off over the last couple of years, we're starting to see some more activity in that space, especially in the early stage, which is really exciting. So like boring wins, except for AI, which that also wins.
Yeah, absolutely. I mean, I feel like AI just sort of trumps across absolutely everything. I mean, Kevin, what do you think? Are you optimistic about funding in the US?
I'm cautiously optimistic, I would say. I think to Sophie's point, because funding has kind of dried up, it's not as inexpensive as it was in the past. Venture funds and PEs are being much more selective with regards to the types of opportunities they want to participate in. We at Thredd see, hundreds of fintechs and payment providers and neobanks and others, participating in the space and looking to try to innovate and provide new value propositions. The ones that we've found have had more success are those that have kind of already gone beyond product market fit. So they have some proposition that has had some success in some market or region, and now they're looking to elevate that proposition, kind of go deeper, wider, and frankly expand geographically. This is where we've had quite a bit of success with many players in the space that may have originated in either Asia Pac or Europe and are looking to expand across the globe and across the pond into North America, where we've been able to provide them with a soft landing. The challenge goes back to the whole BIN sponsor landscape, because again, these are not regulated financial institutions. They need to have a bank sponsor. So those that have a more wherewithal from a financial perspective, have been in business for some time, are credible, and have kind of the wherewithal to manage the banking relationship as well as the technical requirements and the compliance requirements, are the ones that I think we're starting to see are having more success. The smaller players with great ideas that want to raise $500,000 to $1 million to take over the world, I think those days are over for a short while, at least, until things start settling.
Yeah. There's an interesting kind of maybe geographic and, I don't know, subject matter angle to this list. So I actually have the list here, and I can read through it, but it might take a while. So if you look at number one, Abound, as I said earlier, it's $1 billion in funding, and that's a lending fintech that has its own credit underwriting models. I think we had one of the founders on the podcast a while ago talking about it. Super, super interesting business. And then tied with that, you've got Wiz, who is a fintech cybersecurity company. And maybe that just tells its own sort of story as well about, the risk in the market and how much these kind of services are needed. But there's also another story, I think, in this top 10 and where the funding is going from. So if you look at the list, it looks like 5 or 6 of them are in the US. There's 2 of them that are in the UK of the top 10. One of them in Australia, one of them in India, and one in Singapore. GXS is the Singapore startup with $170 million raised, which is huge for the Singaporean market. But so, Sophie, I mean, what do you see there? I mean, are you surprised maybe that there isn't more stuff coming out of APAC? So on this equivalent list last year, I think when we were talking about it, there were 2 Indian firms, now just 1. I mean, is there a story there?
Yeah, I think just one note on the kind of top, and I would just urge people when looking at this data to kind of make sure we're comparing apples and oranges. And I know Abound, it was equity and debt. And I think a lot of these companies will announce equity and debt, and then they won't tell the split. And that's like very different from raising just an equity round. So that can also skew the numbers. And I think the thing with the year on year, looking at the mega rounds, is that you will usually get companies will raise every other year. And I think what we've seen with the UK is a lot of our kind of mega companies, like Monzo, for example, raised last year and so won't look to raise for the next 2 years. But yeah, I do think it's interesting that we've seen a drop off in India. It's obviously an absolutely huge market at its natancy. And so, is that a timing thing? Is that an impact on macro? I'm not an expert. I don't invest in that in geographical region, but I imagine that there will be a pipe of companies that will have either raised or an announced next year, or might be just building up to a raise next year. So I think we still need to look at and watch that space with real excitement.
Yeah, definitely watch that space. I'm sure any kind of looming interest rate cuts might have a material impact on the amount of investment into the sector. But on we move. Right. So the next news article, this one comes from Finextra. Monzo brings monthly payments to Apple Pay purchases. iOS 18 released this week, and while the most visible changes are in the ability to turn all of your icons green and even delete the Safari browser, wow, Apple, that's quite the move, the software update is also shaking up online payments. Monzo is the first UK bank to enable paying by installments directly via Apple Pay for its users of its Flex credit card. And that's kind of incredible. I mean, imagine just how seamless that user experience is, right? Elsewhere in the world, ANZ is prepping the feature in Australia, and a firm is supplying Discover credit card customers in the US. The functionality has been left to third-party providers, and Apple cancelled its own pay later service back in June. So, this is the more interesting chat about what Apple is doing with its business model. So, what do we all think about BNPL and Apple Pay?
Yeah, I think that BNPL in general. I mean, my take is it's really not a business. It's a product offering, right? So some of these organizations like Klarna and Affirm, they've come a long way. I remember when they first came into the market, everyone was talking about how they're just going to absolutely change the face of credit, and then they had some challenges with regards to default because ultimately, people weren't paying as they were intended to based on the various requirements that they established, whether 4 or 6 months, et cetera. And what we're starting to see is they're bouncing back a bit because those defaults have actually been reduced, and the reason is because they've put tighter controls on kind of establishing the credit scoring, credit worthiness processes for onboarding, right? Because before it was somewhat loose, and it didn't allow for them to mitigate that risk as much. When you see, companies like Monzo and Apple entering the space, and actually Apple kind of backing out at the end of the day, is because they do see an opportunity for this to be a great tool to acquire new clients. Ultimately, buy now, pay later, can serve as a great credit builder proposition for those that don't necessarily, or maybe underbanked, underserved, and don't have the ability to access credit today. So it gives them an opportunity to kind of get into the game and build some history of payment where there could be opportunities for upsell, cross-sell. So I think that's where we're seeing the interest from, the neobanks in this space. I think it's yet to be determined whether or not, as a standalone value proposition and business model, whether or not this is something that's going to be sustainable. I think it's just going to be a part of a broader value proposition and feature functionality from financial institutions.
Yeah, it's almost like a commoditization that comes in. Once everybody does it, what is the purpose of a standalone thing? And maybe this, Sophie, is the commentary on Klarna as a business model. I mean, okay, yeah, Kevin, as you said, they're doing well, they're profitable, they're growing. But with things like this, if everyone's just going to launch their own, pay flex, pay in 3, whatever you want to call it, proposition, then where does that leave Klarna, do you think?
Yeah, I think it's interesting. Whenever you take a company to investment committee, one of the questions is always, what if big tech do this?
Yeah.
And I hate that question because it's annoying because you can't really answer it. But what if big tech do this and we're seeing this? But I think the really interesting thing about this is the facilitation of buy now, pay later is not difficult. The underwriting and the debt side is the difficult bit. And that's why Klarna was able to scale so quickly and efficiently, because a lot of these merchants who absolutely could not offer this, right? They're not going to go and get involved in debt and underwriting. But they just want to offer their customer a lovely experience. That makes sense. But when you now have the ability for, the neobanks, the banks, to already utilize their, especially when you look at the larger banks, huge history of underwriting and data that can make this more efficient, then it just becomes a very interesting landscape. And I think it'd be interesting to see how it evolves. Aside of the question of is buy now, pay later actually a good thing for customers, and should we be encouraging debt in a high interest rate environment? Question to this industry, but yeah, I think it's gonna shake up the whole consumer credit side of it.
Yeah, I mean, and maybe another question also that we could ask is, do we think that Klarna would ever offer their BNPL through Apple Pay? I mean, they may end up by not having a choice, but in some ways, then they lose contact with the customer. I mean, it's a real head scratching.
Or get acquired.
Or get acquired, yeah. By who? By Apple.
No, that's the question.
It's a very interesting question. And also, if you reflect on Apple having withdrawn from Apple Pay Later themselves, basically saying, we don't want to underwrite this risk. We don't want to be a bank. We want to enable banking. So everybody should just come in and use our tools, and we can just take a clip off the top. It feels like the initial thesis behind, big tech becoming tech fin is sort of changing a little bit to more of an ecosystem enabler play. Any views?
Yeah, I think it's very interesting in terms of, okay, so if you have Apple as your kind of front end distribution model, then like where does brand and consumer interaction fit into this? And it's very different, but it's a very different business model. Then you're just building pipes.
Yeah.
And then, does this just become commoditized as you mentioned before? And I think that also ties into like scaling and how to grow quickly when you're not in charge of the actual acquisition of it. So yeah, I think it requires a bit more thinking about the structure of this industry, who are the different players and where the value lies.
Kevin, have you seen any parallels with the Apple Wallet? I remember when it was launched, there was a concern with, listen, if people just preload their cards into a wallet, as amazing as that is for the customer, a little bit like this, we actually lose that sort of high touch customer relationship in some sense. But I don't feel like that's played out, right? I don't feel like, in fact, if anything, the high touch moments with the customer lie within, the underlying experience, the banking app, the other services that the card providers or the bank actually offers. But I do remember a few years ago that was a fear, right? We're going to completely lose touch. The cards are going to be completely commoditized. What do we do? But has it played out like that? I don't think so.
I don't think so. I mean, we work with Apple to provision our clients' cards to the Apple Wallet. So we manage that process for them. Apple has very specific rules and are very, cautious about who they allow to, to meet the criteria to participate in that type of a scenario. But ultimately, this is just the last mile, right? This is the point of interaction when you're making the payment. What most issuers are looking to do is try to become top of wallet, right? So how do you identify yourself as the main credential that a consumer is going to use within the Apple Wallet when they make a payment, and the service, the value proposition, the engagement with the client and the relationship really happens outside of the Apple Wallet. That happens within the app or some sort of business relationship. But ultimately, I think that this is a tool that all issuers should utilize to now the problem you have is that there's an economic component that makes it somewhat challenging. So if your value proposition and your use case doesn't provide for the commercials necessary to pay for the cost of being part of this ecosystem, then it doesn't make sense. So I see more credit value propositions, kind of fitting into this into this area more than debit or prepaid, just because they're more profitable, and that's kind of where we're seeing the market moving.
Yeah, absolutely. No, it'll be interesting to see what happens. All right. Now we're on to News Roundup, and it's a quick look at more click-worthy news this week that we don't have time to cover in full. And this one comes from Fintech Futures. Dutch neobank Bunk aims to boost headcount by 70% by the end of the year. And the end of the year is not far away. That's only a few months. So the digital bank based in Amsterdam is planning to add more than 730 employees, particularly across marketing, business development, and sales functions. This news follows Bunk's first full year of profitability since it was set up in 2012. The firm is currently gunning for a banking license in the US, along with an EMI license in the UK. And the push for greater headcount bucks a market trend. Klarna, for instance, announced last month that they would be cutting and automating jobs in some of the functions where Bunk is expanding. So, on that note, we spoke to Bunk's Chief of Staff, Bianca Swart, about why they're pushing for growth now.
Now is actually the perfect time to push for growth. I'll explain why. We've always put our users first in everything we do. Over the last years, we've put our full focus in building an amazing experience, right? A product that people love to use. And that strategy is paying off. Our users simply love our product. Being a tech company at heart, we've also developed a highly efficient way of growing. And now that we're profitable, it's the perfect time to accelerate. So at Bunk, we focus on digital nomads who travel the world. Our goal is to make their life easy wherever they go. That's why in our open roles, we focus on 3 key areas. Expanding into the markets that they're in or travel to, understanding their local needs and preferences, and becoming an integral part of their daily lives through, for example, partnerships. So basically, from here, the only way is up.
You heard it, the only way is up. And finally, a look at something a little more lighthearted from the world of business. And this one is from CNBC. Pizza Hut to print job seeker CVs and deliver to employers in New York. The pizza delivery giant has launched a campaign called Resumes. See, I managed to get that right because it's actually spelled resumes. It's an interesting word. That will print customer resumes directly onto a pizza box and send it to an NYC employer of their choice. Pizza Hut has a website set up for the scheme where they will review submissions and select 25 winners. These winners will have their resume delivered right to the door of their company of choice in pizza form. Pizza Hut have been careful to insist that the scheme won't necessarily get anyone a job, but it will certainly get them noticed. So panel, would you want to put your CV on a pizza box?
There is so much good pizza in New York. Why Pizza Hut? I would be sad. I'd just be like, why can't I go and get another slice from somewhere on the street?
I think it's clever. I think it's gimmicky. Great exposure for Pizza Hut. You got to give kudos to their marketing team. To Sophie's point, they're probably struggling in New York compared with some other options. So they got to find ways to differentiate. I would be impressed, I'd say, if I were to receive this in a unique circumstance. But if it becomes, kind of commonplace and it's being used by everyone, then it's no longer. It's no longer something that's unique and interesting. So I think it's a great opportunity to get exposure for Pizza Hut, get them out there. We're talking about it, so apparently it's working.
Yeah, I'd love to be a part of the PR firm coming up with that idea. I think it's so fun, and I've heard of quite a few things like this over the years. I think it might actually result in somebody getting a job. Who knows? I mean, it's a pretty edgy thing to do.
Actually, I'm craving a pizza now.
No, you want pizza, but are you craving Pizza Hut? That's the question.
I think also we need to innovate on CVs, don't we? Come on, they haven't changed in hundreds of years. Let's shake them up. Maybe not pizza, but
I think it's going more towards video CVs is what we're seeing. I've received one. It's unusual, but it allows you to have more of a personal touch, and get a sense of the person's personality and demeanor. So that could be a trend.
Yeah, it could also add a lot of pressure as well in some senses. I mean, it's definitely, there's been lots of stories around automation of kind of sifting through people using kind of AI algorithms that just bucket people into different areas and taking the human touch away. So actually something like a video is actually in some ways more human than what we're seeing. But anyway, pizzas. And on that note, that wraps up this week's Fintech Insider News. Thank you so much to today's guests. And where can people find out a bit more about you and your companies? Sophie.
Yeah, you can find me on LinkedIn, searching my name. And you can find out more about Foxe Capital at foxecapital.com. We invest in early stage, pre-seed, seed, early series A fintech companies. So yeah, get in touch if you want to chat.
Awesome. And Kevin?
Yeah, happy to connect with anyone that would like to exchange ideas on how we might be able to support them with their enablement requirements and growth requirements across multiple geographies. I can be reached at kevin.foxe@thread.com. That's THREDD.com. Or you can find me on LinkedIn, linkedin.com/in/FoxeKevin.
Awesome. And you can find me on LinkedIn at DavidBG. Thanks for listening, everyone. If you like what you've heard, please follow our podcast and don't forget to leave us a review. It helps us to make a better show and helps others find us. And if you're listening on Spotify, you can now drop us a comment and tell us what you thought of the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcasts@11fs.com. We also now have a brand new WhatsApp community channel where you can get the inside track on all of our content, and you can get involved via the link in the description below. Thanks very much and goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Cora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.